Welcome, everyone. Today, we are going to dive deep into the Heiken Ashi Scalping indicator, a really effective tool for those quick, short-term trades that so many traders love. Stick with us all the way through because by the end, you will know how to set up and use Heiken Ashi for scalping, and you will have the confidence to make fast, informed trades even when the market is moving all over the place. Let us get into it. Are you tired of getting lost in the chaos of market noise? Let me introduce you to a tool that can change the way you see trends for good. First things first, let us cover what Heiken Ashi is. You may be wondering what makes Heiken Ashi different from the regular charts that traders usually look at. Heiken Ashi is a special kind of chart that takes price data and smooths it out, making trends much easier to see while also reducing the noise that can distract us. Unlike those regular candlestick charts that show every tiny price movement, Heiken Ashi averages out the price day over two different periods. What does this mean for you? It means that the candles you see on your screen will show a more consistent trend. This consistency gives you a clearer picture of where the price is actually heading, instead of getting caught up in all the small ups and downs that can be misleading. When looking at Heiken Ashi charts, it is helpful to understand some key chart patterns that you can use to make better trading decisions. These patterns help identify whether a trend is continuing or if a reversal is likely to occur, and they are important tools in the scalper's toolkit. The first pattern you will want to pay attention to is the doji candle. In Heiken Ashi, a doji candle forms when the opening and closing prices are very close to each other, resulting in a small or no body with wicks on both sides. This indicates indecision in the market and often appears before a trend reversal. When you see a doji, it is a sign that you should be cautious, as the current trend might be losing momentum. Another important pattern is the continuous series of green or red candles without wicks on one side. For instance, during an uptrend, if you see green candles with no lower wicks, this means that there is strong bullish momentum. This pattern suggests that the trend is likely to continue, and it could be a good opportunity to enter a long position. Similarly, during a downtrend, a series of red candles with no upper wicks shows strong bearish momentum, signaling a good opportunity to enter a short position. The spinning top is another pattern to keep in mind. This candle has a small body and longer wicks on both sides, indicating that there is a lot of price movement but not much change in the closing price. In Heiken Ashi, a spinning top suggests that buyers and sellers are battling for control, and it can signal that a trend may be coming to an end or that a period of consolidation is about to begin. When you see this pattern, it may be best to wait and watch for a clearer signal before making your next move. Another key pattern is the hammer or inverted hammer. A hammer forms during a downtrend and has a small body with a long lower wick, indicating that buyers are starting to push the price back up. This can be a sign that a reversal to an uptrend may be coming. An inverted hammer, on the other hand, has a long upper wick and forms during a downtrend, also signaling a potential reversal. These patterns are particularly useful for scalpers looking to catch reversals early. The engulfing pattern is also very powerful when using Heiken Ashi charts. A bullish engulfing pattern occurs when a green candle completely engulfs the body of the previous red candle, indicating a strong shift in momentum to the upside. Conversely, a bearish engulfing pattern happens when a red candle engulfs the previous green candle, showing that bearish momentum is taking over. These patterns can be great signals for entering trades, especially when they occur after a strong trend. Finally, pay attention to the 3 inside up and 3 inside down patterns. The 3 inside up pattern begins with a red candle, followed by a smaller green candle that forms inside the previous red one, and then a larger green candle that closes above the first red candle's high. This pattern indicates a potential reversal to the upside. The 3 inside down pattern is the opposite, starting with a green candle, followed by a smaller red candle, and ending with a larger red candle that closes below the first green candle's low, indicating a reversal to the downside. Understanding these chart patterns will give you an edge when scalping with Heiken Ashi. They help you determine whether to enter, hold, or exit a trade based on the strength and direction of the trend. By combining these patterns with Heiken Ashi's smoothed price action, you can make more informed trading decisions and improve your chances of success. So, why is this type of chart so useful when we are talking about scalping? Scalping is all about speed and making decisions very quickly. Since Heiken Ashi smooths out the chart and focuses on trends, it is perfect for traders who need to make fast decisions without getting tripped up by the little fluctuations that often lead to false signals. When you are trying to catch these rapid trades in a fast-moving market, you need a tool that cuts through the noise and gives you a clear idea of the trend. Heiken Ashi does just that. Now let us go ahead and set up the Heiken Ashi chart so you can follow along and see exactly what we are talking about. First, make sure you are on a trading platform that has Heiken Ashi charts. If you are unsure which platforms offer this, some popular options are daytrader or TradingView. Once you are on your trading platform, switch the chart type to Heiken Ashi in the settings menu. Once you do that, it is time to set the time frame. Remember, for scalping, we want smaller time frames. You can use 1-minute charts, 5-minute charts, or 15-minute charts depending on how quickly you want to enter and exit your trades. If you are planning to make very fast trades, the 1-minute or 5-minute chart may be the best place to start. After you have your Heiken Ashi chart set up, it is also helpful to add a few more indicators like moving averages or the relative strength index to help you confirm your trades. This way you will have a better sense of when to enter and when to exit. It is also very useful to recognize specific chart patterns that can guide you in deciding whether to enter or exit a trade. One important pattern is the flag pattern. In an uptrend, a flag pattern appears as a brief consolidation that moves slightly downward, indicating a pause before the trend continues. This pattern is called a bullish flag, and it shows that the price is likely to continue rising after a brief consolidation. During a downtrend, a bearish flag forms, which is a slight upward consolidation indicating a continuation of the downward trend. Spotting these flag patterns can help you make entries that align with the trend's continuation, maximizing profit potential. Another pattern to look out for is the triangle pattern, which comes in several forms, including ascending, descending, and symmetrical triangles. An ascending triangle forms when there is a flat resistance level and higher lows, which usually suggests a breakout to the upside. A descending triangle, on the other hand, forms when there is a flat support level and lower highs, often suggesting a breakout to the downside. A symmetrical triangle occurs when both the resistance and support lines converge, indicating that a significant price movement is likely to occur in either direction. Recognizing these triangles can help you prepare for breakouts and catch price movements right when they happen. The double top and double bottom patterns are also essential to understand. A double top is a reversal pattern that forms when the price reaches a high point twice but fails to break above it, signaling a potential bearish reversal. This pattern can be very helpful, when trying to decide when to exit a long position. Conversely, a double bottom occurs when the price reaches a low point twice without breaking lower, suggesting that the trend might reverse upward. This pattern is useful for identifying potential entry points for long trades. Head and shoulders is another classic chart pattern that can be beneficial in identifying trend reversals. A head and shoulders pattern forms during an uptrend when the price makes three peaks, with the middle peak being the highest. This pattern indicates a potential reversal to a downtrend. The opposite version, called the inverse head and shoulders, forms during a downtrend and signals a potential reversal to the upside. Watching for these patterns can help you spot major reversals early, giving you a chance to either enter or exit before the market makes a big move. Another useful pattern is the wedge pattern, which can either be a rising wedge or a falling wedge. A rising wedge forms during an uptrend and indicates that the trend may be losing strength, leading to a potential bearish reversal. A falling wedge, however, forms during a downtrend and suggests that the price may soon break to the upside, indicating a bullish reversal. These wedge patterns are particularly helpful for predicting when a trend may be about to end and reverse, giving you a good opportunity to adjust your trading strategy accordingly. These chart patterns, combined with Heiken Ashi's smooth visuals, will help you gain a deeper understanding of the market dynamics and make more precise trading decisions. Recognizing these patterns in real time allows you to take advantage of market movements efficiently and avoid false signals that could lead to losses. Practice identifying these patterns on your Heiken Ashi chart to improve your ability to react quickly and confidently in the market. With everything set up, it is time to talk about how to actually read Heiken Ashi candles for scalping. In the Heiken Ashi chart, the candles are color-coded to help you understand what is happening with the trend. Green candles mean that the market is going up, which means it is a bullish trend, while red candles mean the market is moving down, so that is a bearish trend. Here is a trick to make it even easier. When you see candles that do not have wicks at the bottom during an uptrend or no wicks at the top during a downtrend, it is a strong signal that there is a lot of momentum in that direction. On the other hand, if you start to see wicks on both sides of the candles, it is often a sign that the market is getting indecisive and a trend reversal might be on its way. Paying close attention to these candles will help you avoid getting caught in a trend that is losing steam. Let us talk about a couple of specific strategies you can use with Heiken Ashi to make the most of your scalping. First, we have a trend following scalping strategy. The idea here is to catch small price movements that follow the direction of the trend. To do this, you need to watch for a series of green candles that have very small or no wicks if you want to go long. This is your cue that the trend is strong, and it may be a good time to enter a trade. If you are looking to go short, you would look for a series of red candles with very little to no wicks. Your exit signal will come when you start to see wicks appear on the candles, or when the candle color changes from green to red or from red to green. That change means that the trend could be weakening or even reversing, so that is your cue to take your profits and step out. In addition to these basic strategies, understanding some advanced chart patterns can significantly improve your success rate with Heiken Ashi Scalping. One such pattern is the rising three methods. This continuation pattern occurs during an uptrend and consists of three small bearish candles that fall within the range of a large bullish candle, followed by another bullish candle. This pattern indicates a pause in the trend, followed by a continuation of the bullish movement, and provides an excellent opportunity for entering a long trade. The falling three methods is the opposite of the rising three methods. It occurs during a downtrend where you have three small bullish candles within the range of a large bearish candle, followed by another bearish candle. This signals that the trend is likely to continue downward, giving you a good entry point for a short trade. Another advanced pattern to consider is the morning star and evening star. The morning star pattern appears during a downtrend and signals a potential bullish reversal. It consists of three candles, a long bearish candle, a small bodied candle that can be either bullish or bearish, and a long bullish candle. The evening star pattern is the opposite and appears during an uptrend, signaling a bearish reversal. It also consists of three candles, a long bullish candle, a small bodied candle, and a long bearish candle. Recognizing these patterns can help you anticipate major shifts in trend direction, allowing for better timed entries and exits. The piercing line and dark cloud cover are also important reversal patterns that can be applied effectively in Heiken Ashi charts. The piercing line pattern occurs during a downtrend and consists of a long bearish candle followed by a bullish candle that closes more than halfway up the body of the previous bearish candle. This pattern suggests that the downtrend is losing momentum and a reversal to the upside may be imminent. The dark cloud cover is the bearish counterpart occurring during an uptrend. It involves a long bullish candle followed by a bearish candle that closes more than halfway down the body of the previous bullish candle, indicating a potential trend reversal to the downside. These advanced chart patterns, combined with Heiken Ashi's ability to smooth price action, provide you with powerful tools for making more informed trading decisions. By learning to recognize and act on these patterns, you can better identify high-probability trade setups and improve your chances of consistent success while scalping. The next strategy we will discuss is reversal scalping. This strategy is about spotting when a trend is about to reverse so that you can take advantage of that change in direction. With Heiken Ashi, you want to watch for the candles to change color. If you are in a series of green candles and then you start to see red, that is a sign that the market could be shifting direction. This is your opportunity to enter a short trade. On the flip side, if you see red candles changing to green, it may be time to enter a long trade. Another key thing to watch out for is when wicks appear on both sides of the candles. This usually signals that the market is about to reverse direction. Once you enter the trade, keep an eye out for any signals that show the trend is weakening. This can help you exit in time before the market shifts again. To improve your trading success with Heiken Ashi, it is a good idea to add some indicators for confirmation. Start by adding a moving average to your chart. A moving average with a period of 20, 50, or even 200 is a good place to start. This depends on your trading time frame. The moving average will help confirm which way the trend is heading. If the price is above the moving average, the trend is bullish, and you might consider a long position. If the price is below the moving average, it supports a short position. You can also add the relative strength index. This shows whether an asset is overbought or oversold. If the relative strength index is above 70, it might mean the asset is overbought. This could signal a reversal. If the relative strength index is below 30, the asset might be oversold, meaning a bounce could be coming. Another useful tool is the moving average convergence divergence. This helps you see when momentum is shifting. When the moving average convergence divergence line crosses above the signal line, it can confirm a bullish trend. When it crosses below, that confirms a bearish trend. In addition to these, you may also consider adding Bollinger Bands. Bollinger Bands help you identify periods of high or low volatility. They also provide insight into possible price reversals. When the price touches the upper band, it may indicate that the asset is overbought. Touching the lower band could suggest it is oversold. The average true range, or ATR, is another helpful indicator. It measures market volatility. Using the ATR can help you set appropriate stop-loss levels. It does this by showing how much the asset tends to move during a specific period. Consider using Fibonacci retracement levels to identify potential support and resistance areas. These levels can give you key points where price might reverse or experience a temporary pause. This can help you make better entry and exit decisions. Additionally, the parabolic SAR, which stands for stop and reverse, is another tool that can help you determine potential trend reversals or continuations. It does this by plotting dots above or below price action. By combining these indicators with Heiken Ashi, you can gain a more complete picture of market conditions and make more informed trading decisions. Of course, no trading strategy is complete without talking about managing risk. Scalping can be fast and exciting, but it is very important to make sure you are protecting yourself from big losses. When you are scalping, always set tight stop losses. If you are in a long trade, place your stop loss just below the most recent low. If you are in a short trade, place it just above the recent high. It is also smart to adjust the size of your position carefully. You do not want to risk more than 1 or 2% of your entire account on a single trade. Scalping is not about hitting a home run on every trade. It is about making a lot of small, successful trades and locking in those gains quickly. Set small take-profit targets and keep moving on to the next opportunity. There are also some common mistakes you want to avoid when scalping with Heiken Ashi. First, do not overtrade. It can be very tempting to keep entering trades, especially when you are seeing movement in the market. But be selective. Only trade when there is a clear trend or a clear reversal based on Heiken Ashi signals. You should also avoid trading in slow, choppy markets. Scalping is most effective when the market is moving fast, so look for high volatility times. Finally, make sure you stick to your trading plan. If your Heiken Ashi candles are telling you to exit, do not ignore that. Follow your plan and do not let your emotions make you chase trades that are no longer smart. Here are a few practical tips that can help you get even better at scalping with Heiken Ashi. If you are new to scalping or new to using Heiken Ashi, start by practicing in a demo account. This way you can get comfortable with the strategy before you risk any real money. It is also a good idea to focus on very liquid markets like major forex pairs or popular stocks. These markets allow you to execute your trades quickly and tend to have smaller spreads, which is really important when you are scalping. Liquidity ensures that your orders are filled promptly, reducing slippage and keeping your costs low. Another helpful tip is to use consistent position sizing. This means determining how much capital you are willing to risk on each trade and sticking to it. Consistent position sizing helps manage your risk effectively and prevents significant losses, which is crucial in the fast-paced world of scalping. You also want to be consistent with your time frames. If you start with the 1-minute time frame, stick with it for that session. Switching between different time frames can lead to confusion and make it difficult to follow your strategy consistently. Scalping relies on quick decisions, so you need to be focused and disciplined. Another great way to improve your scalping with Heiken Ashi is to refine your exit strategies. Deciding when to exit a trade is just as important as knowing when to enter. Consider using trailing stop losses to lock in profits while allowing your trade to continue moving in your favor. By trailing your stop behind the price, you can maximize gains while minimizing the risk of giving back profits. Lastly, avoid scalping during low volatility periods. The best scalping opportunities come when there is high market activity, as price movements tend to be more predictable and easier to capitalize on. Pay attention to major news releases or market openings, as these often bring increased volatility, creating favorable conditions for scalping. Another idea you can try is combining Heiken Ashi with other chart types to get a fuller view of the market. You could use traditional candlestick charts alongside Heiken Ashi. Heiken Ashi is great for smoothing out price action, but candlestick charts can sometimes give you more precise points for entering and exiting a trade. You could also try using range charts together with Heiken Ashi. Range charts focus on price movement without worrying about time, so using both charts together can help you filter out noise while also giving you a good sense of clean trends for scalping. Let us go ahead and do a quick recap of what we have covered so far. The Heiken Ashi Scalping Indicator is a really powerful tool for traders who are looking to make quick, short-term trades. It takes price action and simplifies it, making trends and reversals much easier to see. To get started, set up your Heiken Ashi chart, add indicators like moving averages and the relative strength index for confirmation, and focus on either trend following or reversal strategies depending on what the market is doing. Heiken Ashi scalping can be an excellent way to take advantage of short-term moves in the market. With enough practice, you can really start to see the benefits of using this tool for your trading. Stick with it, take your time, and refine your approach. Before long, you will be able to make smart, fast trades even when the market is at its most volatile. Let us know if you have questions or thoughts about the Heiken Ashi strategies we talked about today. We would love to hear how it works for you.